Hey everyone, welcome back. If you've been watching the markets, you've probably noticed that Bitcoin has seen a significant price drop recently, and that's naturally got a lot of people talking. Today, we're going to break down what's happening in a calm, straightforward way so you can understand the moving parts behind the headlines. First, let's set the stage. Bitcoin, like many other assets, doesn't move in a straight line. It goes through cycles of ups and downs. The recent downward move has been sharp, and it's caused a ripple effect across the entire crypto market. When you see big red numbers on the screen, it's easy to feel alarmed. But our goal here is to look past the initial reaction and understand the why. So, what are some of the key factors driving this price action? One of the biggest is broad market sentiment. Right now, there's a good deal of uncertainty in the global economy. Concerns about inflation, interest rate hikes by central banks like the Federal Reserve, and geopolitical tensions all contribute to what we call a risk-off environment. In times like these, investors tend to be more cautious. They might sell assets they consider higher risk, like tech stocks and, yes, cryptocurrencies, and move into assets they see as safer, like cash or government bonds. Bitcoin isn't operating in a vacuum. It's connected to the wider financial world, and it feels these shifts in mood. Another major piece of the puzzle is liquidity. Think of liquidity as the ease with which you can buy or sell an asset without causing a big price change. When central banks raise interest rates, it effectively makes money more expensive to borrow. This tightens the amount of cash flowing through the financial system. With less easy money available, there's less capital to speculate on assets like Bitcoin. This reduction in liquidity can put downward pressure on prices, as there are fewer buyers ready to step in at higher price levels. It's a fundamental shift in the financial landscape that affects everything, not just crypto. Now let's talk about something that's more specific to the crypto world: leveraged liquidations. This sounds complicated, but the concept is pretty simple. Some traders use borrowed money, or leverage, to make bigger bets on the price of Bitcoin. For example, a trader might put down $1,000 of their own money, but borrow another $9,000 to control a $10,000 position. This is called 10x leverage. If the price of Bitcoin goes up, their profits are magnified. But if the price goes down, their losses are also magnified. If the price drops by just a certain percentage, their initial investment can be wiped out. When this happens, the exchange automatically sells their Bitcoin position to cover the loan. This is a liquidation. Now, imagine this happening to thousands of traders all at once as the price falls. These forced sales create a flood of new sell orders on the market, pushing the price down even further and faster. This can trigger a domino effect, where one wave of liquidations causes the price to drop enough to trigger the next wave. This is often called a long squeeze, and it can dramatically accelerate a price decline. It's really important to distinguish between what these market mechanics are and what the headlines might say. You'll often see sensational articles with titles about a crypto crash or the end of Bitcoin. While these headlines get a lot of clicks, they often miss the nuance of what's actually happening. What we're seeing is a market correction driven by macroeconomic factors and internal market structure, like leverage. It's not a sign that the technology has suddenly failed or that its core principles have changed. The Bitcoin network is still processing transactions. Miners are still securing the network, and developers are still building on top of it. The price is just one metric, and it's often the most volatile. This brings us to a crucial point: understanding market cycles and volatility. Bitcoin has a history of being extremely volatile. It's not unusual for it to experience drops of 50% or more from its all-time highs. We've seen these cycles play out multiple times over the past decade. There are periods of rapid price increases, often called bull markets, followed by significant corrections, or bear markets. For anyone involved in this space, recognizing that this volatility is part of its nature is key. It's not like the stock market for a blue-chip company. It's a relatively new and evolving asset class. So, what's a calm and reasonable takeaway from all of this? First, it's a reminder that investing in any market, especially one as new as crypto, comes with risk. Understanding your own risk tolerance is fundamental. Second, making decisions based on fear or panic is rarely a good strategy. When you see prices falling rapidly, the emotional impulse is to react immediately. But taking a step back and looking at the bigger picture, the macroeconomic environment, the market mechanics, the historical context can provide valuable perspective. This isn't about being bullish or bearish. It's about being educated. Understanding why the market is moving allows you to navigate it with more confidence and less anxiety. This recent drop isn't some mysterious, unprecedented event. It's the result of identifiable forces: fear in the broader economy, tightening financial conditions, and the unwinding of leverage within the crypto market itself. As we move forward, it will be interesting to see how these factors evolve. Will inflation cool down? Will central banks change their policies? How will the market adapt to the new liquidity environment? These are the questions that will likely shape the next phase of the market cycle. Instead of trying to predict the exact bottom or top, a more sustainable approach is to focus on learning and understanding the fundamentals. Thank you for tuning in today. My hope is that this explanation helps demystify some of the recent price action and gives you a clearer framework for thinking about it. Knowledge is your best tool in any market. If you found this helpful, consider subscribing for more straightforward content like this. Stay curious, stay informed, and we'll see you in the next video.